Welcome to the PJ Finance Show. This presentation will cover topics related to drivers in bond spreads and ways of raising capital from a company's inception to its maturity. First, it is important to clarify what this spread is. The spread is a reference to the difference of return of a particular bond compared to the comparable treasury bond. As a reminder, treasury bonds do not have default risk. As corporate bonds have default risk, investors need to be compensated more as an incentive to offer money to companies. The business cycle is known as the trend of economic upswings and downswings. It is important to consider where the economy may be in the business cycle to understand bond performance, and what types of fixed income instruments are performing best. In the beginning of the business cycle, meaning directly after a recession, bond performance in terms of default is at its best. During this time, interest rates have been lowered, and the debt a business is able to take on is easily serviced as interest payments are most economic. Here, high-yield debt has a rather low spread compared to treasury bonds because the risk-free rate is so low. Ratings agencies play a huge role in all of this as well. Ratings agencies, while not an objective standard for risk and safety for investments, do impact a firm's ability to keep positions on their books. This is because institutional lenders are not permitted to keep speculative-grade investments as it is not part of their business plan. As a result, as bonds slip in rating, there is a peculiar relationship with who is an appropriate customer. In the same way that institutional investors are not permitted to hold speculative-grade debt, high-yield funds do not hold investment-grade debt. So, as a product moves from investment-grade towards speculative-grade, there is not an appropriate customer. Once the debt is downgraded to speculative grade, this product is known as a fallen angel. At this point, investment-grade funds need to clear the position, and high-yield funds can now purchase it. This type of product is seen as a very strong investment in the grand scheme of things for high-yield investors, and it is very attractive to them.
Now, let's talk a little bit about how companies raise capital. Initial startups can begin their capital acquisition through anything equity-based crowdfunding or rewards-based crowdfunding. Other avenues of capital raising include investment from venture capital, private equity, and hedge funds. From business inception, capital is largely raised in this order, where venture capital make the most early capital injections and hedge funds make later capital investments. Outside of early and late-stage investments, initial public offerings, or IPOs, allow companies to go public, and these companies offer stock to institutional and retail investors. Institutional investors largely obtain shares in the initial public offering, and retail investors obtain the shares through a secondary market. When raising capital, many venture funds and private equity firms will negotiate favorable terms to exit. Because they are early investors, these firms typically have substantial leverage to use as a means of receiving favorable terms and conditions to safeguard their investment. This can include the use of liquidation preference, ratchets, and favorable seniority. Thank you for watching. This presentation on drivers in bond spreads and ways of raising capital is brought to you by the PJ Finance Show.